okay? And then the last 20% that you're not trading with your cycle, you trail out with your candlesticks, right? And that'll keep you in the trade for a long time. And then here we get another daily cycle cross right there. Okay, and we've got, let's see, we got 2 bearish engulfing setups, right? So this one was before the cycle cross. So if you short here with a tight stop, you know, it makes sense that price might come back and rip above you. So that's why maybe you only short 20% of your size on this one. And then you wait for the second engulfing and the cycle cross to short your major size. And what that might look like is, you know, a 30 or short here and 2/3 down here. So your average is somewhere in there. All right. And at that point, we've got about, we'll say a 6% stop loss. What is going on? Oh, I got this tool on. Yeah, we'll say you've got a 6% stop loss. So same as before, you're just going to figure out how much you can risk to where 6% is no more than 2% of your stop loss. You know, doing some quick math here, it's probably like 12,000. Let's try this. $12,000 times 6% stop. Nope, we can risk more than that. Let's try 25,000 times a 6% stop. 1,500. We're getting closer. Let's try 30. Let's try that 32,500 again. 6% of that is 1,950. Perfect. So once again, we can risk 32.5K to where if we take a 6% loss, we're not risking or losing more than our 2% max loss of account. Right? And then same as before, right? This was your short entry. Stop is above here. For 20%, you're going to trail it out with every bearish candle. So we get another bearish engulfing here. Move your stop. Okay, another huge bearish engulfing here. Move your stop. Now your cycle is already low here. So once that crosses up, this is the point where you're out 80% of your short size. Right? And if you shorted here, this is the pivot low. So your first wave of profits would be taken at that level. Well, in this case, it just nuked it in one candle. So you might have gotten lucky and made some extra profits. But if this was just one candle into here, it makes sense to book some profits in case this is a higher low in front of this level. But it wasn't. So in this particular scenario, you would have made a lot more money, about 15% on your size. And then the last 20%, you're just trailing out, right? You get another bearish engulfing here. You can move your stop on your last piece. Another bearish engulfing there. You can lower that stop again. A huge bearish engulfing there. Lower your stop again. Right, I guess, oh, we're at this is the bottom then. So we're finally at the bottom of the bear market. Right, and that would be where you get stopped out on your last 20%. Right, and then you get a cycle cross, another setup. Right, topping tail setup. So that would be a stop of about 20%. So you can risk like what was it, 10,000? Yeah, you can risk up to $10,000 there. Take profits when your cycle gets low. Right, cycle has crossed up. I would be out 80% of the size. In the last 20%, you're just trailing, right? Trailing that stop loss. And then boom, you get stopped out. And your last 20% was in profits of about 5%, while most of it was in profits of 10 to 20%. Okay, so that would have been, you would have successfully caught and played 3 short plays there after waiting through all of this for the market to tell you you're in a bear market when you made a lower low. Okay? You guys see how we're bringing in position sizing, our risk plan, all of that together? All right, and then one thing I haven't discussed that much here that I do want to hit on is hedging. And if you're not familiar with it, hedging is just a way to manage your risk. So if I'm in this trade here, right, and I'm short whatever I said it was, $10,000, but we look at the weekly and we can see, all right, I'm short $10,000 here. We've got a weekly cross up. We've got, you have to remember, this is right here. Okay, right there. We've got a monthly cycle just crossed up. So we've rode an entire bearish wave down. You know, long term, I probably don't want to be shorting here, which is why we're just shorting based off the daily and we're playing those swings, right? We want to be in and out with our cycle because at some point, you know, this is going to be a full wave back up, right? So at this point, since we're so heavily short, we might want to hedge our risk by being slightly contrarian long on our higher time frame. Meaning, see, we've got a bottoming tail set up here, right? A nice long wick, and the next candle moves away from it. So perhaps, even though in this region we're heavily short, core short our day trade, our swing trade account, maybe I want to be hedged long a little bit on my higher time frame. Meaning, I'll go back to my daily for this one, right? And let me just show you why this helps us and how it's useful, right? So looking at big picture, this is like that monthly cycle, right? And we're at the bottom of it. But I'm still going to take these short plays because we can see throughout here, there's still a ton of short plays that would have made good money for a whole year. So even though the bottom had been reached and it makes sense to hedge a little bit long, we still want to be core short until we're making higher highs and higher lows. But because I'm heavily short, in case the market just rips, which it does over here, I want to have a piece hedged long so that whatever my stops are for my short plays, I'm making money if those get hit. Right? So we'll go back to this play over here. Right? If I'm taking this setup, a topping tail setup, cycle high, whatever, and we've also got this bullish wall put in, right? Price rallied 100% there. Maybe when we come back down halfway, this bullish wall, I go ahead and I finally buy some long-term long position. Just that, right? If my long here rallies all the way up to my stop for my short trade, I've made 50% on my long while my stop gets hit for 2%. I give you guys time to think about what I just said, right? Because we're risking on the short side 2% of our account with this trade. So maybe when we come back down and that moves in our favor, you know, we get a cycle across here in the daily, our long term looks pretty good. Maybe then I start to get some hedges going long, right? So that if at some point this short trade goes against me, which eventually will happen because eventually you're going to re-enter a bull market. When that happens, you want to make sure that you're primed, that you're hedged. Okay. All right. So that's essentially how I hedge. If I'm too heavily long and the market's looking kind of weak, maybe I'll go contrarian short a little bit so that if my long stops get hit, right, then my shorts are making money. Another good way to do this, I'll go to present day. now for this. Another good way to do this is if you're long Bitcoin, you could be short an asset that is correlated with that. In this case, Ethereum, right? If we see here, we'll go look at Ethereum real quick. Ethereum looks pretty much the same as Bitcoin, right? Or rather, it's performing the same as Bitcoin, but almost like on steroids, right? So here's where Bitcoin broke 6K. When that happened, Ethereum dumped 60%. Right? And when Bitcoin broke 6K, it dumped 50%. And then when Bitcoin bottomed, it pumped 34%. But when Ethereum bottomed, it pumped almost 100%. So maybe steroids wasn't the right term for it. Let's say it's more like trading Bitcoin on leverage, right? When you're trading an altcoin that is directly correlated to it, which it won't always be the case, right? You always got to be careful for the current situation to change. Because at some point, Bitcoin might be flying while Ethereum's dumping. We don't know, right? But for the time being, they're correlated. So if I'm short, right? If I'm short really heavy on Bitcoin into these lower highs, right? What am I going to do if these get hit? I'm just going to take my stops and I'm going to take my loss. But wouldn't it be better if not only if I didn't just take that loss, but while Ethereum gave me a cycle setup and an engulfing setup, maybe I was long. Maybe I'm long with a loose stop. And then if my stops get run on BTC, my hedge is in profits, right? And it doesn't have to be anything massive, right? 40% is great, but this could just be a small entry. Enough so that if I get a 40% gain on it, maybe that 40% gain is equal to my 8% stop on my short or whatever. Is that making sense? You really just want your hedge to make up for your main position being wrong. Got another good example. We'll look at Netflix, right? Step out of crypto for a second. Okay, currently, Netflix looks to be entering into a longer-term bear market. Okay, we've closed below the bands. The seller volume was pretty massive into that point, and the buy volume has been kind of weak. Right? And so now we'll know if this is going to be a long-term bear by another lower high in front of these levels. So maybe because of this, I'm going to start shorting the rally, right? Daily cycle is getting high. We're getting close to our pivot here. I'm going to open my first short. But we also have to keep in mind, this might just keep rallying, right? We've got 20% until this major pivot. And on the weekly, we've got an engulfing setup plus cycle low. Right? Sorry, here it is. Right? So it's possible we get a full cycle up into this level to make a lower high. And it's also possible that this is just a long-term higher low and that we're going to make higher highs. So not only am I going to start my short here with a stop above here, but I'm also going to take some small long plays on my lower time frames to make profits on the way to here. Okay, so I circled this zone. Let's hop into the 4-hour, our lower time frame for our swing trade. Right? And so maybe I'll hedge some longs when we break out here at 337 with a nice tight stop. Right? Either below a candle that you like, or if you have to, below the major pivot. But at that point, your hedge is pretty weak. But you don't want your hedge to be massive. The point is not to have a large hedge. The point is just that, right? If I'm looking to short here and anything into here, what am I going to do if price just rallies up to there? Yeah, I'm going to short there, but wouldn't it make sense if I could make some money on the way up to where I'm going to short? So then your hedge could be making some money in case your stop gets run. Maybe you what if we just short this all the way up and then it just runs our stop, right? Instead of just taking a max loss, a 2% loss, now you're taking a 2% loss and maybe like a 1% gain, right? Depending on how much you hedge. That makes sense. And here we'll go back to Bitcoin, because the same thing goes for Bitcoin too, right? We've got this. Let me close this. We've got this massive resistance above us at 6K, right in this zone. So this is going to be a very good short opportunity, in my opinion, in the future. So yeah, I'm going to want to short into there. But like we were talking earlier, perhaps when we start making higher highs and higher lows in the short term, like that, perhaps then we take a hedge long, which is going to be contrarian to our higher time frames, like the weekly and the monthly. But maybe we take a hedge long so that going up to this resistance, we make some money too, in case our shorts are wrong. Right? Does that make sense? I know I asked, does that make sense? And you guys can't actually respond. But when I ask that, if it doesn't make sense, make note and shoot me a message so I can clarify. All right? But that's pretty much all I wanted to say on hedging. I don't hedge that often, but it is really nice when you're in a trade going in one direction, but there's signs it could go in the other direction. All right? And especially with crypto right now, with Ethereum being so correlated to Bitcoin, you can really minimize your risk by, having a long on Bitcoin and a short on ETH, or a short on Bitcoin, a long on ETH, right? And as long as both trades are fitting your risk management plan, you're golden. Okay. So let me go through my notes here. I think I hit everything. Yep. Wait for the first pullback after a change in market structure to add heavy size. We got that. We talked about it on the short side, but the same thing goes for long side, right? When you're core short, you want to wait for a pullback after a change in market structure to add heavy size, right? We need a higher high and a higher low to prove that this market is intermediate term bullish. And then, only then, once the market structure has changed, can we go long. Just like back in the last bear market, you didn't want to be going short heavily up here until you broke down. And then immediately after you broke down, you had 3 or 4 amazing short plays. Right? Okay, so I hit that note. We hit position sizing with candle setups. We already know that. Max losses. I'm taking break even. We touched on that. I think that's pretty much all I wanted to hit, guys. That's going to round up this section of strategy, guys. And we're also going to do a Q&A. So you guys will be able to watch all these videos and give us feedback. And then if you guys thought there was anything we could improve on, or something that was missing or needed clarification, I'm going to go back in, re-record what needs to be re-recorded before we finalize everything. Okay? So criticism is very much welcome, guys. All right? And you guys can just hit me up in the chat if you want that. That's going to be all for this video. Peace.